Have you ever wondered why the US dollar gets stronger during a global crisis, even when the crisis starts in America? Or why it also strengthens when the US economy is booming, but weakens when things are just? Okay, this strange behavior is one of the biggest puzzles in finance, but there's a powerful theory that explains it all. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're diving deep into the dollar smile theory, a fascinating framework that helps predict the dollar's seemingly contradictory movements. Understanding this concept is key for anyone looking to navigate the complexities of global markets. Whether you're an investor, a business owner, or just curious about how the world's most important currency really works. We'll break down why the dollar smiles, what it means for your money, and where we might be heading next on this curve. The dollar smile theory was developed by Stephen A., former strategist at Morgan Stanley. To explain the US dollar's counterintuitive behavior under different global economic conditions, instead of moving in a straight line with economic growth or risk sentiment, the dollar tends to strengthen in two opposite scenarios and weaken in the middle, creating a curve that looks like a smile. The theory states that the US dollar strengthens when the global economy is in a deep crisis, is the left side of the smile. It then weakens during periods of stable, moderate global growth, which forms the bottom of the smile. Finally, it strengthens again when the U.S. economy significantly outperforms other major economies, creating the right side of the smile. This model is crucial for economists, investors, and currency analysts because it clarifies why the dollar can appreciate both during widespread market panic and during periods of strong economic expansion in the United States. It's a roadmap to understanding the dual nature of the dollar as both a safe haven and a high-performing asset. Let's start with the left side of the smile, where crisis and risk aversion lead to a strong dollar. In this scenario, global markets shift into a risk-off mode when fear and uncertainty spike due to a financial crisis, a pandemic, or geopolitical conflict. Investors around the world rush to dump risky assets like stocks and emerging market currencies. Their primary goal becomes capital preservation, and they flock to what they perceive as the safest assets available. The ultimate safe haven in the global financial system is the US dollar, and more specifically, US Treasury bonds. This surge in demand for dollar-denominated assets causes the currency to appreciate sharply. Several factors drive this phenomenon. First is the powerful demand for the dollar as a safe haven currency. When global volatility rises, investors instinctively seek refuge in the dollar due to its stability and the depth of U.S. financial markets. Second, the dollar is the world's primary reserve currency, meaning central banks, corporations, and financial institutions globally hold vast amounts of it for international trade and financial transactions. During times of instability, the preference for holding liquid dollar assets intensifies. Furthermore, U.S. Treasuries are considered the safest investment on the planet, backed by the full faith and credit of the U.S. government. This reputation triggers massive capital flows out of emerging markets and other developed economies and into the United States. History provides clear examples of this dynamic. During the 2008 financial crisis, a global liquidity crunch pushed investors into the US dollar, even though the crisis originated in the US subprime mortgage market. Similarly, at the onset of the COVID-19 pandemic in March 2020, worldwide shutdowns triggered a frantic dash for cash, causing a massive and rapid spike in the dollar's value. More recently, The Federal Reserve's aggressive interest rate hiking cycle in 2022 created a powerful rally in the dollar as global capital flowed back into higher-yielding American assets, tightening financial conditions worldwide. This part of the curve is fundamentally driven by fear and the global financial system as structural dependence on the U.S. dollar. Now, let's move to the bottom of the smile, where a period of moderate, stable global growth leads to a weaker U.S. dollar. This is the boring phase for the global economy, where things are growing steadily. Risk appetite is healthy, and there are no major shocks on the horizon. In this calm environment, investors are no longer driven by fear and instead feel comfortable seeking higher returns outside the United States. The urgent need for the dollar as a safe haven diminishes, and capital begins to flow outward. The dollar weakens in this phase for several key reasons. When global growth is synchronized, the interest rate differentials between the U.S. and other major economies often narrow. If U.S. interest rates are similar to or even lower than those in other countries, holding dollars becomes less attractive from a yield perspective. This encourages investors to allocate their money to emerging markets or other developed nations that offer higher growth potential or more attractive interest rates. With reduced market volatility, the demand for the dollar as a protective asset naturally declines. This improved global risk appetite means investors are more willing to diversify their portfolios and take on calculated risks in other currencies and markets. This is typically a period where the U.S. dollar experiences a sustained downtrend as financial flows spread out more evenly across the globe, chasing growth and yield wherever they can be found. Finally, we arrive at the right side of the smile, where the U.S. dollar strengthens once again. This time, however, the rally is not driven by fear but by confidence. The dollar appreciates because the U.S. economy is outperforming the rest of the world. This is a growth-driven surge where the United States becomes the primary engine of global economic expansion, attracting capital from all corners of the globe. Several mechanisms push the dollar higher during this phase. Strong U.S. economic performance reflected in high GDP growth, robust job creation, and strong consumer spending boosts investor confidence in American assets. This often prompts the Federal Reserve to raise interest rates more aggressively than other central banks to manage inflation, creating a significant yield advantage for the dollar. Global capital naturally flows into U.S. assets to capture these higher returns. Beyond interest rates, the outperformance of U.S. corporations, particularly in leading sectors like technology and finance, attracts massive foreign investment into the U.S. stock market. The United States' role as a leader in technological and financial innovation creates a sustained long-term demand for American assets. This side of the smile reflects a dollar strengthening out of pure economic might and optimism, a stark contrast to the fear-driven rally on the left side. At its core, the dollar smile theory is deeply intertwined with investor psychology specifically. The powerful emotions of fear and greed that drive capital flows. During downturns, the principle of loss aversion takes hold. Investors become far more sensitive to potential losses than to potential gains, accelerating the flight into safe haven assets like the U.S. dollar. This flight to quality phenomenon shows that in a crisis, investors prioritize liquidity, trust, and safety above all else. Institutional investors who manage vast sums of money tend to react very quickly and in large volumes, which amplifies the dollar's movements. Retail investors often follow these trends, sometimes exacerbating the herd behavior that leads to rapid capital flows into or out of the dollar. Understanding these psychological drivers is absolutely crucial for predicting the extreme currency movements that define the edges of the smile. So, what does the future hold for the dollar smile? Analysts widely expect the theory to remain relevant for the foreseeable future due to the structural dominance of the U.S. dollar in global finance. Several factors will likely determine where we are headed next on the curve. Shifts in Federal Reserve policy are paramount. Future rate cuts would likely push the dollar toward the middle of the smile, while a return to rate hikes could strengthen it. Persistent large U.S. fiscal deficits could pose a long-term risk, potentially weakening the dollar's performance during the stable growth phase. Geopolitical tensions or new conflicts will almost certainly trigger a flight to safety, strengthening the dollar on the left side of the smile. Similarly, any signs of a sharp global recession would likely cause the dollar to surge again. The dollar's position on the smile curve has significant implications for various asset classes. Commodities, which are often priced in dollars, tend to weaken when the dollar is strong. Gold can rally during crises alongside the dollar, but may fall when a strong U.S. economy drives a growth-led dollar rally. Cryptocurrencies, which are highly sensitive to risk sentiment, typically perform poorly during a dollar surge. Even real estate can be affected by the capital flows and borrowing costs dictated by the dollar-S dynamics. In conclusion, the dollar smile theory reveals that the U.S. dollar is paradoxically strongest at two extremes. During deep global crises and in times of exceptional U.S. economic outperformance, it tends to weaken only when the global economic environment is stable and growth is balanced across the world. For investors, this framework serves as an invaluable roadmap for anticipating currency movements, planning asset allocation, and protecting portfolios during periods of high volatility. By understanding where the world currently sits on the smile curve, you can make more informed decisions about your investments in currencies, stocks, bonds, and other global assets. It's a powerful lens through which to view the interconnected world of modern finance.